US's total national debt is on the verge of hitting the maximum debt ceiling of 31.4 trillion, and if that maximum ceiling is not increased by the US Congress, then technically US government will default on a debt obligation very soon. And in this video, I will discuss how USA came to this point and what are the possible solution option that the US Congress has in front of it right now to avert the US government debt default. But to note at this point that throughout modern history, the US has never defaulted on its debt. The federal administration has a self-imposed borrowing max limit named the debt ceiling, and over time that has been increased or suspended altogether to try to avert the US from defaulting on its debt. Now, what is a debt ceiling in USA? In the United States, the debt ceiling is a legislative limit on the amount of national debt that can be incurred by the US Treasury, thus limiting how much money the federal government may pay on the debt that they already have in their balance sheet. The debt ceiling is an aggregate figure that applies to gross debt, which include debt in the hands of the public and intra-government accounts. The debt ceiling has been around since 1939, when Congress chose to set a maximum borrowing limit instead of having to approve every expenditure by the Treasury Department, and since 1959, Congress has raised the debt ceiling 86 times. Since then, raising the debt ceiling has been routine for presidents and Congress of both parties. That all changed in 2011 when the legislators became hugely concerned about the government's expanding deficit, that is a gap between government spending and what it earns as its revenue, and its escalating debt. So in 2011, USA did increase the debt limit, but only after a nasty political fight and quite a bit of market uncertainties and hit to the US economy. During that period, the markets were rattled, stock prices plummeted, and people's retirement savings were affected. It was the first time in the US history that federal government's credit rating was downgraded. Even though USA managed to avoid defaulting, the Treasury concluded that the delays in raising the limit caused harm to the economy, which took several months to recover. US national debt is growing super fast. In 1982, the total national debt was 3.46 trillion, and that has grown to 31 trillion as of the end of 2022. So why does the US have so much debt? The national debt is an accumulation of federal budget deficits. Each new spending program and tax cuts adds to the debt. The largest deficit thus far goes to the President Barack Obama. He added 8.3 trillion to the debt, a 70% increase. And foreign countries like China and Japan buy treasuries to invest their export proceeds that are denominated in US dollars. And these foreign countries are happy to lend to America, their largest customer, so that it will keep buying their exports. Purchasers of treasury bills are confident that the US has the economic power to pay them back. During recessions, foreign countries increase their holdings of treasury bonds as a safe haven investment. And definitely the US government has benefited from low interest rates. It couldn't keep running the budget deficit if interest rates skyrocketed. And further, significant events that have led to substantial increases in the national debt include the Afghanistan war, the Iraq war, the 2008 economic crisis, and the COVID-19 pandemic. From 2019 to 2021, spending rose nearly half, mainly due to the pandemic. Tax cuts, stimulus packages, augmented government expenditures, and reduced tax income due to high joblessness are typically to blame for sharp rises in the national debt. The US national debt is made up of a variety of components similar to a person who has outstanding payments for a house loan, auto loan, and credit cards. It can be classified into two categories: debt held by the public and debt held by the government itself, which is called the intra-governmental debt. The national debt does not take into account any financial obligations of state and local governments, for instance, debt to finance state-run projects, nor those of individuals such as personal credit card debt and mortgages. This graph right here compares data from 2012 and 2022, shows the difference in growth between debt held by the public and the intra-governmental debt. While both of these make up the overall national debt, they have increased at different rates over the past few years. The large increase in public debt can be attributed to the increased funding of programs and services during the COVID-19 pandemic. Intra-governmental debt has not increased by quite as much since it is primarily composed of debt owed on agencies' excess revenue invested with the Treasury. The revenue of the largest investor in Treasury securities, that is the Social Security Administration, has not increased significantly in recent years, resulting in this slower intragovernmental holding increase. And looking at this figure of federal debt as a percent of GDP, during 2020, the US national debt held by the public rose to 100% of GDP for the very first time since the end of the Second World War. Now, why compare government debt to GDP? Because utilizing the ratio of publicly held debt to GDP is a better method of understanding a nation's fiscal standing than simply looking at the raw debt amount, because it displays the burden as a proportion of the country's entire output, which is related to their capacity to finance or pay it back. This measure also makes it possible to evaluate one country's fiscal situation over time or compare the debt load of multiple countries in a sensible fashion. A large nominal debt may not be as much of an issue if a country has a vast economy and can easily settle it. For instance, the debt held by public in 1946 in US was $242 billion, or 1% of today's figure. However, with a GDP of only $228 billion, the public debt was 106% of the economic activity, which is about 9 percentage points higher than it is current level. And now coming back to the topic of this video, which is about debt ceiling, let's see how much the debt ceiling has grown in the USA. Since the conclusion of World War II, Congress and the President have made alterations to the debt ceiling on roughly 100 occasions. In the 1980s, the debt ceiling was raised from less than $1 trillion to near $3 trillion. During the 1990s, it was doubled to nearly $6 trillion, and in the 2000s, it expanded to more than $12 trillion. Since February 2013, legislators have chosen to suspend the debt limit rather than to raise it in an exact dollar amount 7 times. And debt ceiling suspension means the government can borrow as much as it needs in order to pay off its current debts and obligations. After the suspension ends, the debt ceiling will automatically be raised to reflect how much was borrowed. In 2021, the debt limit was increased twice instead of suspended, with the latest increase taking place in December 2021 when it was formally increased to $31.38 trillion. Now let's quickly see how the CDS market or the credit default swap market reacted during 2011 debt ceiling increase session in the USA. The CDS market experienced an increase in volatility after May 2011 when the debt ceiling debate had become a critical issue. From July to the start of August 2011, an inversion of the CDS curve was seen, and that was the very first inversion of the US sovereign CDS curve ever recorded in history, indicating that credit protection was more expensive in the short term than the long term, and that markets were actually getting very nervous about an impending US government default in the short term. And on January 13th, the Treasury Secretary Janet Yellen writes letter to Congress raising red flags on debt limit. So she writes to Kevin McCarthy, the Speaker of the House. So Public Law number 11773 increased the statutory debt limit to approximately $31.38 trillion on December 16, 2021. As you know, the debt limit is the total amount of money the United States government is authorized to borrow to meet its existing legal obligations, including Social Security and Medicare benefits, military salaries, interest on the national debt, tax refunds, and other payments. I'm writing to inform you that beginning on Thursday, January 19th, 2023, the outstanding debt of the United States is projected to reach the statutory limit. Once the limit is reached, Treasury will need to start taking certain extraordinary measures to prevent the United States from defaulting on its obligations. The two extraordinary measures Treasury anticipate implementing this month are redeeming existing and suspending new investments of the Civil Service Retirement and Disability Fund, which is CSRDF, and the Postal Service Retiree Health Benefits Fund, and suspending reinvestment of the Government Securities Investment Fund of the Federal Employees Retirement System Thrift Savings Plan. Congress has expressly provided Treasury with authority to take these actions, and prior Treasury secretaries have used these measures, which will reduce the amount of outstanding debt subject to the limit and temporarily provide additional capacity for Treasury to continue financing and operations of the federal government. After the debt limit impasse has ended, CSRDF, Postal Fund, and G Fund will be made whole. Presidents and Treasury secretaries of both parties have made clear that the government must not default on any obligation of the United States, and as noted, Treasury secretaries in every administration over recent decades have used these extraordinary measures when necessary. Yet, the use of extraordinary measures enable the government to meet its obligation for only a limited amount of time. It is therefore critical that Congress act in a timely manner to increase or suspend the debt limit. Failure to meet the government's obligations would cause irreparable harm to the U.S. economy, the livelihood of all Americans, and global financial stability. Indeed, in the past, even threats that the U.S. government might fail to meet its obligation have caused real harms, including the only credit rating downgrade in the history of our nation in 2011. Increasing or suspending the debt limit does not authorize new spending commitments or cost taxpayers' money. It simply allows the government to finance existing legal obligations that Congress and presidents of both parties have made in the past. And here she gives some estimate on the time limit as to when the debt ceiling will be completely exhausted. So she writes, while Treasury is not currently able to provide an estimate of how long extraordinary measures will enable us to continue to pay the government's obligations, it is unlikely that cash and extraordinary measures will be exhausted before early June. Now, what will happen if USA defaults on its debt? After the USA hits the debt ceiling limit, immediately after that point, the US government could tap a stockpile of $500 billion in cash to finance its deficit until some more time. There's no exact date when the debt ceiling will be reached. Some estimates from economists from various banks like Goldman Sachs says that the debt ceiling actually will be hit by the third quarter of 2023. Now, if the USA fails to raise the debt limit in time due to political gridlock, then as an immediate fallout, that would create greater risk to government spending and ultimately to economic growth than it would to Treasury securities themselves. Because USA will not stop paying the due interest on Treasury securities, as that would be a technical default, and in that scenario, pretty much the whole global financial system will go through a shockwave. So the US federal government will reallocate funds in order to make interest payments on United States Treasury securities. This will create a significant deficit that must be accounted for by postponing payments like salaries to government employees, veterans benefits, and social security entitlements, payments that millions of people depend on. Now, let's quickly understand the difference between government technical default and government shutdown. So, if Congress fails to pass the necessary and appropriate bills ahead of time hitting the debt ceiling, a shutdown is triggered, which leads to a temporary suspension of salary payments to those employed or contracted by the government. However, in a default, many more parties are not paid. In the context of debt ceiling, default would be caused by government surpassing the debt ceiling and lacking sufficient funds to meet all its duties to citizens and creditors. Without enough money to make payments, any payment may be potentially stopped, comprising all government expenditure, obligatory payments, interest on the debt, and disbursements to US bondholders. A government shutdown would be upsetting, but a government default is an absolute catastrophe. Now, after hitting the debt ceiling, the government would not be able to borrow any additional money, but could spend any revenue that comes in however they would want. But those revenues would not be enough to cover all the spending, because the US government runs budget deficit, meaning it spends more than it brings in through revenues. So that means that it must borrow to pay its bills. Those bills includes funding for social safety net programs, interest on national debt, and salaries for defense of the US. And if ultimately ever the Treasury Department were unable to make payments to lenders who hold federal debt, what is known as a default, investors would demand much higher interest rates in the future to loan the government any money. It would be similar to what happens when borrowers, that is like people like you and me, miss credit card payments. That is, our credit ratings go down and the interest rates that after these default we have to pay goes up. Such a scenario would add dramatically to the government's interest payments, which the White House projects will cost the equivalent of 2.6% of the total US economy over the next decade, further squeezing the government budget. And it would also threaten to destabilize bond market globally, because US Treasury bonds are largely seen as one of the safest investment in the world. If a technical default occurs or even a possibility of it is seen, there may be grave economic repercussions. A technical default would cause turmoil in both domestic, that is in the US market, and foreign financial market, as they rely on the steadiness of US debt and the US economy. Rates of interest will go up and the demand for treasury securities would go down as investors halt or reduce their investment in them, escalating the likelihood of a default further. Even the fear of a default during US congressional disagreement can push the borrowing cost quite a bit up. According to the Government Accountability Office, that is GAO, the 2011 debt ceiling stalemate costed the US government some $1.3 billion. If Treasury bond yields rise significantly, other interest rates throughout the economy would also rise, impacting car loans, credit cards, mortgage, business investments, and other forms of borrowing and investing. Banks and other financial institutions that hold a lot of treasuries would suffer a decrease in their assets as the value of the treasuries decreases, potentially limiting credit availability in the market, as was witnessed during the Great Recession. And in this regard, a September 2021 report from Moody's Analytics estimated that a default could have repercussions akin to the Great Recession, a 4% decrease in GDP, 6 million job losses, and a 9% unemployment rate. Furthermore, Moody's estimated 15 trillion loss in household wealth, including a potential 1/3 drop in stocks at the height of the sell-off. And beyond Moody's in this subject, the White House Council of Economic Advisor, that is CEA, cautioned that the macroeconomic consequences of a default or even coming close to one could endure for months or even years. In a report, the CEA revealed that after the debt limit was raised in 2011, mortgage rates rose by 0.7% to 0.8 percentage points for 2 months afterwards, with auto and consumer loan rates staying elevated for multiple months. Moreover, if there was an actual default, the report cautioned that the elevated unemployment rate could remain high for 2 to 4 years. And here is the original report published in October 2021 named Life After Default. A default would fundamentally hinder the federal government from serving the American people. Payments from federal government that families rely on to make ends meet would be endangered. The basic functions of the federal government, including maintaining national defense, national parks, and countless others, would be at risk. The public health system, which has enabled this country to react to global pandemic, would be unable to adequately function. Everyone in America would feel the effect of default. If the United States were to default, tens of millions, including families with children, retirees, and veterans, would quickly, even overnight in some cases, face the prospect of losing the regular federal payments that help them to make ends meet. Then the report goes on saying if the federal government ended up missing or delaying payments, millions would be unable to put food on the table or pay rent. Consider the impact of federal government not fulfilling its obligations on 3 illustrative American families: an elderly couple, a veteran living alone, and a young family with 2 children. All of them benefit from the federal government in a myriad of ways. For instance, as seen below, a typical married elderly couple relies on more than $4,800 a month just from Social Security and Medicare, not to mention other programs they qualify for. There are many other functions of the federal government that we often take for granted and that would be in peril after a default. For example, the federal government keeps our country safe by paying the salaries of 1.4 million active duty military personnel and their families, the deployment of personnel, the maintenance of equipment, the procurement of supplies and other supportive activities would risk being frozen after a default, hampering the defense of the country at a time when there are ample threats to national security. There are many other functions of the federal government that we often take for granted and that would be in peril after a default. For example, the federal government keeps our country safe by paying the salaries of 1.4 million active duty military personnel and their families, the deployment of personnel, the maintenance of equipment, the procurement of supplies and other support activities would risk being frozen after a default, hampering the defense of the country at a time when there are ample threats to national security. The same holds for expenses related to counterterrorism and intelligence measures, which could leave America more vulnerable to potential threats. And the report then continues, the global economy, which relies on a strong US economy, would begin to slide into a financial crisis and likely a recession. US Treasury debt is the world's benchmark safe asset and its interest rate acts as a basis for pricing of countless financial products and transactions around the globe. The US dollar is also world's premier reserve currency. A default would send shock waves through global financial markets and would likely cause credit markets worldwide to freeze up and stock markets to plunge. Employers around the world would likely have to begin laying off workers. The 2008 financial crisis had ripple effects throughout the global economy that recorded back to US shores, causing firms to lay off workers and cut private investment. A financial crisis driven by a default has the potential to be even worse, in addition to hitting a global economy not fully recovered from the pandemic. And now talking specifically on the political equations in the US with respect to the debt ceiling increase. So in the US political arena, there have been calls to get rid of the debt ceiling altogether. So when Democrats control the House, they generally adopt the so-called Gafford rule, named after US Representative Dick Gafford, which automatically increases the debt limit if needed to cover authorized spending. No separate vote is needed. But when Republicans control the House in the US, especially under a Democratic president, they usually reinstate the debt ceiling vote to gain budget leverage. And now currently the Republican has a majority in the House of Representatives, so Washington and Wall Street is bracing for a revival of brinkmanship over the nation's statutory debt limit. For years, Republicans have sought to tie spending cuts or other concessions from Democrats to their votes to lift the borrowing cap, even if it means eroding the world's faith that the United States will always pay its bills. Now, back in control of a chamber of Congress, the Republicans are poised once again to leverage the debt limit to make fiscal demands of President Biden. And Republicans are getting ready for a high-stakes showdown with President Biden over raising the federal borrowing limit. So Republicans used the debt limit as a leverage to negotiate a spending limit on non-entitlement spending back in 2011 with President Barack Obama. Annual caps and the threat of automatic cuts caused expenses to fall as a share of GDP for several years. But the cost was high because the defenses and domestic social welfare spending were both capped. Military readiness of the United States government suffered greatly until Republicans began to trade defense increases for social welfare increases during the late Obama and Trump years. But that was the years after 2011, and now the world has actually changed. It is much more dangerous place right now, with Russia invading Ukraine, China threatening Taiwan, Iran getting close to a nuclear weapon, and jihadists far from defeated. So a sequester deal similar to the one in 2011 in the USA would be a more dangerous proposition from the perspective of US security. So at the end, all of which means Republicans will have to pick their spending targets carefully and explain their goals in reasonable terms and then sell this to the public as a united team. That pretty much wraps up this video. If you liked it, do smash the like button and also don't forget to subscribe. See you in the next one.